Hello everyone, welcome back. I'm Lenny, and this week's module will be focused on borrowing money. You may watch the video as often as you like. You should watch the videos before our in-class sessions. This will help you to prepare for class. By participating in this class, you are taking an important first step to building a better financial future for you and your family. Before we begin something new, let's review what we discussed in class. Savings accounts and saving money. How can you save money? First, consider your needs versus your wants. Think about the items you purchase on a regular basis. Coffee, gas for the car, phone plans, food. Can you cut back on these expenses? Second, use direct deposit or automatic transfer into your savings account. Third, pay your bills on time. Fourth, stop using check cashing services. Open a bank or credit union account. Fifth, if you get a raise, place some of that money in savings. Or if you pay off a loan, continue to put that money in savings. Pay off your credit cards quickly. Save your change every week. Save the money from your tax refund. Saving money is important to prepare for emergencies or big purchases. It is important to have money in savings in case you lose your job or need to pay medical bills. Once you have savings, you become more able to borrow money. Let's begin today's module, Borrowing Money in the United States. Sooner or later, almost everyone needs to borrow money. When used wisely, credit can benefit you and your family. But first, there are some things you should know about the value of credit and its costs. Credit is the ability to borrow money. When you borrow money on credit, you get a loan. You make a promise to pay back the money you borrowed plus some extra. The extra amount is part of the cost of borrowing money. This cost is called interest. We talked about interest with a savings account too. If you use credit carefully, it can be useful to you. Not being careful, like not paying your loan on time, can cause problems. The type of credit we will talk about in this course is personal or consumer credit. Any money you borrow must fit into your budget. You have probably heard the term good credit. Having good credit means that you make your loan payments on time to repay the money you owe. If you have good credit, it will be easier to borrow money in the future. However, if you have problems using credit responsibly, meaning you do not pay your loan on time, it will be harder to borrow money in the future. Credit is important because it can be useful in times of emergencies. It is more convenient than carrying large amounts of cash. It also allows you to make a large purchase, such as a car or a house, and pay for it over time. Credit can affect your ability to obtain employment, housing, and insurance based on how you manage your credit. Credit is a loan often secured by collateral or a guarantee. Banks and credit unions take a risk when lending money to you. Therefore, they want to be sure that their money is secure. Collateral is security that you provide the lender. For example, you promise a possession that you own, such as your car, to the bank or credit union, that it can be used as repayment if you cannot repay the loan. A guarantee is a form of collateral. For example, co-signing is a form of guaranteeing a loan. If a person with no credit history asks another person to co-sign a loan, the co-signer is equally responsible and has to pay the loan if the borrower does not. Well, what is the difference between a secured loan and an unsecured loan? In a secured loan, the borrower offers collateral for the loan. For example, collateral is given up to the lender if the loan is not paid back. Home loans are examples of secure loans. An unsecured loan is not backed by collateral. An example of this is a credit card. Other examples would be personal and student loans. An asset is something valuable that you own, like a car or property, such as your home. Now that you know what credit is, let us talk about the different types of loans that you can obtain. One is called a consumer installment loan. This type of loan is used to pay for personal expenses for you and your family. Examples include auto loans, where the car you are purchasing is used as collateral for the loan, so this would be a secured loan. You can also get an unsecured loan for short-term needs, such as buying a computer or paying for a wedding. The term installment loan refers to any type of consumer loan that is paid back over time on a fixed schedule. When you receive an unsecured loan, you will pay a much higher interest rate. The second type of loan that we will talk about are credit cards. Credit cards give you the ongoing ability to borrow money for household, family, and other personal expenses. Having a credit card allows you to buy things without actually having the money right away. Remember that if you are not careful in spending, you can get into big trouble and be burdened with heavy debt. You need to be sure you are able to make the minimum monthly payment on your credit card bill. The third type of loan we will discuss are home loans. These are used to buy a house. A home purchase loan is made for the purpose of buying a home. It is secured by the home you are buying. When you get a loan, there are generally two additional costs that you must pay: fees and interest. Fees are charged by banks and credit unions for activities such as reviewing your loan application and servicing the account. Interest is the amount of money a bank or credit union charges for allowing you to use its money. The interest rate can be either fixed or flexible. Fixed rates stay the same throughout the term of the loan. Flexible rates might change during the loan term. The loan agreement will show the details of the rate changes. Lenders are required by law to tell you 4 items. First, the amount financed. This is the amount of the loan the lender is letting you borrow. For example, $5,000 for 1 year. Second is the annual percentage rate, or APR. APR is the amount of interest added to the loan. It is usually stated as a percentage. For example, 12%. 12% of a $5,000 loan over 1 year is $600. Third are finance charges. They include items such as interest, service charges, and loan fees. For example, the finance charge total is $600 in interest and $250 in loan fees and service charges. Lastly, the lender must tell you the total payment. This is the amount you will have paid after making all scheduled payments. Using the $5,000 loan as an example, the total payment includes the original amount borrowed, $5,000, plus finance charges. For this loan, the finance charges were $600 in interest, plus $250 in loan fees. This equals $850 in finance charges. The total amount of the loan is $5,850. Here, the loan is for 1 year. But if the length of the loan is longer, the monthly payments will be lower. However, you will end up paying more interest in the end. Nafisa wants to get a loan to buy a used car. The car costs $6,000. She decides to apply for a loan from her credit union, where she already has a checking account. She applies for a secured loan using the car as collateral. She is approved for the loan because she has good credit. The loan officer explains her loan. The amount financed is $6,000 over a 1-year period. The APR, or interest rate, is 6%. 6% of $6,000 is $360. Her finance charges include the interest and lender fees. Her lender fees totaled $80. The total amount Nafisa will owe if she pays her loan on time and in full is $6,440. Before our next class, I want you to consider why you would take out a loan. What would you buy? We will look at the cost of loans in class. See you next week.